I'd like to welcome you all to the third day of the B&G Said South Africa in Focus Reviving Economic Growth series, which we are hosting in the Bloomberg offices in Johannesburg. The week-long series will feature keynote addresses, panel discussions, and interviews with policymakers, C-suite executives, and newsmakers as we seek to amplify the voices of women across a variety of sectors. Today, our esteemed panel will focus on capital markets. South Africa's capital markets are still present great opportunity for investment, raising capital, engaging the temperature in the markets. The Johannesburg Stock Exchange is Africa's most liquid bourse. The country's sophisticated financial markets also give consumers a myriad of financial options and instruments to consider in their investment decisions. However, global developments and changes to policy, like what we've seen with South Africa's pension fund asset allocation limits, may lead to an outflow of funds from the country's asset pool. In particular, I'm referring to changes to Regulation 28 of the Pension Funds Act, increasing the threshold that insurance, retirement, and savings funds can invest offshore to 45%. Effectively making it even more important and urgent to strengthen the attractiveness of local markets. Furthermore, long-standing structural constraints and domestic challenges have limited capital gains in recent years, albeit exacerbated by external shocks like the coronavirus pandemic and the Russia-Ukraine war. The impact of this is visible in the lower levels of foreign domestic investment and the weakening of the rand, which reached record levels this year. Today, the discussion will explore the fundamentals of what it will take to increase investor sentiment and leverage capital markets to revive economic growth. Without further ado, I'd like to hand over to our moderator, Colleen Goku. Thank you.
Did I forget to turn the mic on? Okay, thank goodness. Ladies and gentlemen, welcome to the session where we are privileged to be joined by a distinguished panel of experts, each bringing a wealth of experience and insights to our discussion. We have the privilege of hosting Olga, who's sitting in the center, Head of Credit at Futuregrowth Asset Management, a seasoned professional renowned for her adept management of credit and equity processes. Her journey through esteemed firms like KPMG, Ernst & Young, and Old Mutual has equipped her with a unique perspective on the intersection of finance and growth. Mamokete, sitting right at the end there, is a global market strategist at Standard Bank, whose extensive 10-year career includes enriching experiences at Renaissance, Sasfin, and Absa Bank. Her expertise in global markets brings a valuable international dimension to our conversation. Sitting next to me is Valdine from the JSE. She's the Director of Capital Markets, who brings nearly 2 decades of direct capital market experience to our panel. Valdine's credentials include an advanced management program certification from Harvard Business School and position her as a guiding force in shaping South Africa's capital market landscape. This discussion happens in the backdrop of the uniquely challenging situation in South Africa. The rand is currently trading at above 19 per dollar, having been fouled by a power crisis and geopolitical ructions, which saw it weaken to a record low a little more than a month ago. Yields on benchmark bonds are in double-digit territory and are heading north of 12% if you look at this morning's markets. And it looks likely that a recession in South Africa will be averted this year, but growth remains anemic with forecasts of 0.3% for the year. The global environment as well remains challenging, with elevated interest rates and signals that the dollar may actually remain stronger for longer than expected, which will continue to exert pressure on riskier currencies like the rand. China, which is a big trade partner for South Africa and an important one at that, is also showing signs of slowing, which means bad news potentially for our markets. Against this backdrop of complex challenges and sobering economic indicators, our esteemed panelists are here to shed light on the strategies, innovations, and collaborative approaches that can guide South Africa's path forward. I'm Colleen Goku, as introduced by Amo, and I'm Bloomberg's EM News reporter, and I cover all things to do with the Rattler, aka the Rand. And on that note, I will start with Olga. Can you please start us off? Can you tell us a little bit about how South Africa's economy has generally managed more challenging situations and what the role of capital markets have generally been during those situations.
Sure, thank you, and thanks for hosting us. I think if we start off by breaking down what is the role of capital markets, and certainly as we see it from an investor's perspective, so I represent institutional investment market, we see the role of capital markets as being a meeting place for providers of capital, which is where we fit in, and the seekers or users of capital. And what happens in the capital markets is, we then provide the capital, people use the capital in a transparent manner, in a cost-effective manner. And there's a whole framework and an ecosystem around that needs to be in place. So regulations need to be in place, the policy framework needs to be in place, we need an exchange with transparency and disclosure and all those good things. And so from an investment perspective and the kind of overarching question of what we're looking at, I think it's important to think about the role of capital markets. Is it to create economic growth? Is it to create investor sentiment? And I would argue that it is, no, it's not the primary role of capital markets to do that. And so we can look at an example historically. We can take COVID, huge dislocation in the market, bond yields were spiking, equity markets were tanking, there was a shortage of liquidity, companies were closing. As a lender, so I can only talk to our role in that ecosystem, as a lender in that ecosystem, what we could do and what we have done in other times of economic difficulties is to make capital available for those entities that are sustainable and for those entities that need liquidity and short-term alleviation potentially of terms and conditions, extension of their loan terms, etc., in order to trade through the crisis and kind of come out at the other end. So the provision of capital is our primary function. We're doing that on behalf of our pension fund investors. We act as fiduciaries for them. So it's important that we maintain all the right investment principles in making those investments. And what our clients are looking for is a risk-adjusted return. So what do we need in order to invest our money? We need bankable deals. And so bankable deals, there's a whole ecosystem around that, and we can unpack that a bit later perhaps around what's needed for bankable deals to happen. And from there comes economic growth. So we can look at power and power generation. We need bankable deals in the power space in order to alleviate the power crisis, in order to create the environment where companies can produce more, expand, employ more people, pay more tax, economic growth. So I think it's just important to think about the role of capital markets, and certainly our role as capital providers in that ecosystem isn't de facto to create economic growth. The product of what we do, the product of a market where buyers and sellers of capital can meet and transact effectively, efficiently, and transparently, that should, assuming all the other role players are playing their part, that should result in economic growth, which should result in improved investor sentiment.
Thank you. I think I'll jump to Valdine for this next question, just to hop off from what Olga has said. In the context of South Africa's economic challenges, how does the stock exchange view its role in providing listing and financing opportunities for businesses, particularly those looking to navigate these difficult economic conditions?
Thank you for having me, and good to be on the panel with my fellow panelists. Absolutely. So the role of an exchange is really important in this access to capital discussion, as Olga had mentioned, and what the role of capital markets are. It essentially is that meeting place, and the meeting place to try and create a safe and trusted framework where you could access capital and then have deep and liquid markets thereafter to trade around that capital. For South Africa, the capital markets play a critical role in our economy. And that's a large part because a large part of the economic drivers of South Africa hinge around the developments and the enablements through capital markets. So if you look at our equities market and you look at the listings or the companies on that market, many of them are listed companies but form important economic pillars or drivers or growth factors for the country in the businesses that they run and operate in various sectors, mining, industrials, transport, tourism, agriculture. So there's many facets. What we've seen is that markets have been really connected over the past 5 years, exponentially so. And while markets are cyclical, those cycles are actually shortening because there's so much news flow out at the moment. Currently, we're facing a political landscape that is influencing markets. and it's not just local macro or political factors, but global macro and geopolitical factors. So the role of an exchange within capital markets is vitally important to make sure that all of this can translate in efficient, trusted, deep and liquid markets. As Olga mentioned, there's a framework around which an exchange plays that provides disclosures, transparencies, mechanisms in which to effect trade, views, opinions. And so it's really important that as an exchange, we perform our functions. The JSE in particular is a SRO, a self-regulatory organization. So we have listings and market regulation that governs the listings framework on both equities and debt, as well as the trading in terms of market surveillance and market abuse and integrity. And then we also have various roles we play at the ecosystem level in the stakeholders that we serve. And there are various stakeholders, from the companies looking to raise capital or the companies or governments looking to issue debt, to the investors who put their money into the markets and use these instruments to deploy their own capital, to the banks and the brokers in the intermediary levels facilitating some of that trade flow, as well as the retail investors who actually invest into the pension funds and asset management community to express a view and to exhibit some of their savings. What we saw through COVID was really an exaggerated volatile period, but we've had many periods of crises through multiple decades. Like I said, they're just faster moving now and more connected at the moment. But if you look at the pandemic or you look at the geopolitical issues with the Russia-Ukraine crisis, capital markets become effective ways of expression of fast-moving markets. And what we saw is the role of exchanges, the role of listed venues, which have frameworks in which they operate and govern and regulate and operate, became more important in hyper-volatile markets. You saw an extreme example like Russia. People had been invested in Russia, and then when you had a political influence of Russia and its war on Ukraine, people couldn't access their money through markets, and these were times when people's savings were actually stuck in markets that they couldn't get their money out. So, so the role of an exchange is extremely important to try and keep a trusted place of integrity to help people express a view, either to raise capital, either to access their money after their money is invested. So having liquid, trusted markets become really important.
Thank you, Valdine. Olga, I'd like to come to you, hopping off from what Valdine has said about how sentiment can be affected and volatility can be introduced by reactions in the market, etc. We've seen kind of the same happening now. As you mentioned, there's some domestic factors that have led to a sell-off in local markets, and they're like international factors that are unfolding that are affecting our domestic markets. In this environment, especially with the higher global interest rates and the declining trust in, what I would say anyway, is a decline in trust in local assets and the government, leading to a weighing down of the rand and the bonds, South Africa will be one of the countries that will be looking to ask for money potentially next year to cover some debt that's coming due. And I'm trying to imagine, with all of that weighing domestically and the global environment being the way it is, do they still have access to the market? And if they don't, what can they look at? What can they do? How are they going to refinance this amount of money? I think we have one bond at least coming due in the first quarter of next year, and rates are probably likely going to be ridiculously high in global markets still. So I'd like to know from you what you reckon our financing may look like.
Okay, so there are a couple of questions in one that you've just asked. And if you think about the financing conditions for South Africa, South Africa is raising probably about the highest amount in cash that it's ever done at the moment, and that is in local markets. A lot of the funding is concentrated still in local markets, and we've got the privilege of having deep and liquid financial markets, and that have been able to meet the demand for cash that the state has. In terms of the offshore funding, a lot of what they've done recently is redirect their funding towards the IFIs. So a lot of money raised from the IMF, that was during the crisis, the World Bank, the African Development Bank, etc. So that pool of capital has been quite deep. So the question is, what happens going forward? I think if you look at the Eurobond market specifically, the market might be expensive, but it's still open. And the hope that countries would have, including ours, is that there is a period over which rates are high, but that rates will over time start to roll over, and that market conditions, or at least pricing, will normalize, whatever that normal looks like. So there is a sense in which there is a temporariness to the situation versus it being permanent. But I think the broader question and the deeper question is around what role the South African government plays as it issues more and more and more and consumes more and more and more capital. What does it do to the rest of the players in the market? I think in our market, it's probably inconceivable that you'll get to a point where the government cannot raise funding. But you need to recognize that that is funding that is not going to other investments. Firstly. Secondly, they do affect the cost of capital for the rest of the borrowers in the economy, and the extent to which they borrow does ultimately affect everyone else. So if you look at, for instance, what banks have been doing with their cash over the past 5 years or so, an overwhelming amount of the capital that banks have has been used towards buying government bonds. And that is capital that is not being used in other places. And what you do then tend to have is a situation where if Olga, for instance, is trying to think about funding infrastructure, the hurdle rate that she's going to apply to that is going to be set at, well, government costs this much, I need a margin over that. And so, there is a sense in which the high borrowing requirement is a problem for the whole economy. But I also think it does present a risk for the South African state itself. So if you don't have a situation where rates go up and then they come down globally, for instance, then you are continuously borrowing more and more and more at higher and higher prices. We do know, for example, that currently for this fiscal year, debt service cost will consume about 20% of revenue. That is a very, very high number. If I think back historically, the kind of like level that government was targeting was 10%. So that means out of every single cent that government collects, 20 cents of that, instead of it going to education, to healthcare, to all of these other things, goes towards paying back debt or servicing debt. That is an unpalatable amount to be using in that manner. And also, you do highlight one thing, that the rollover risk has increased. The amount that government has to pay back every single year is higher and higher and higher. And to the extent that that continues, it does run the risk of creating instability for other financial assets as well. Because if something goes wrong around that funding, it does affect how the market functions across the board.
Thank you. Olga, I think I'll take that opportunity to jump in back to you. We've talked a little bit about the Russia and Ukraine issue, and I think Futuregrowth, as far as I understand, is committed to funding that's sustainable and funding that talks to the aspects of ESG. Is that correct?
Yes, that is. So in our credit assessments, when we're being asked to make investment decisions on a longer term horizon or shorter term horizon, we need to look at financial factors and also non-financial factors. And the non-financial factors are the environmental, the social, and the governance factors. Our investment thesis is that the ESG, or the non-financial factors, can and do have financial impact over time. So it might not be immediate, and you might not be able to quantify exactly how much or when that impact is going to happen, but they do eventuate. And we've seen, even as recently as yesterday, you saw with Sasol, they took that huge 35 billion rand impairment purely as a result of environmental concerns. Their cost of capital has gone up, the emissions are too high. These things we have known about for a very long time. Sasol is one of the world's biggest emitters, and the cost of that non-financial factor is now coming to land in financial metrics. Weakened share price, massive impairment on the balance sheet. And so that very much is our thesis, that in making investment decisions, we need to look not just at today's financials, which also, let's remember, are backward facing, but on a forward-looking view, trying to figure out which of the, what is the cash flow balance sheet and all the financing stuff, what's that going to look like on a forward-looking view, but also looking at environmental factors, social factors, and governance factors, and how are those risks that we've identified and how they're being managed by the company, how those are going to eventuate and land up as financial risks, because that's what we are being asked to fund, is on a forward-looking view, the cash flows and assessing whether the company will be able to repay our pension fund clients.
So how does that work out when you're looking at the investment landscape in South Africa? For example, you said that Sasol, for example, doesn't sound like it would be one of the companies you'd be willing to recommend or put money behind. So how does that affect the kind of companies or funding strategies that you use? Like, who are you looking at then? Who are you interested in? If you could just give us like a broad stroke idea of what your investments currently look like, and do they include SOEs? Why or why not?
Again, a lot of questions there. So, I mean, our mandate is South African. We manage the South African portion of people's pension funds. Our mandate is to invest in South African assets. We have a very heavy leaning towards infrastructure. We run a very big infrastructure bond fund. It's got the longest track record, nearly 20 years of performance, very good performance. We are heavily invested in this country as citizens, as taxpayers, as a company in our economy. And what we look for is sustainable companies. Our clients need a risk-adjusted return. It's people's pension funds. It's not a development finance. There isn't a development finance institution. It's not like our pension fund clients can say, well, we're happy to forego some return because, for the good of the country. That's absolutely not the case. It's people's pension fund. They have to earn a commercial return so that they can retire with their hard-earned savings. And so with that in mind, our investment universe is very broad within the South African context. We have got a very heavy leaning towards, as I said, infrastructure, but our mandates are very broad and very wide. We do have developmental funds, which by their mandate are restricted from not investing in non-developmental assets. But again, that's a fairly wide definition. When we look at investments, what we really are trying to unpack is the risk-return framework. And so it's very often not at that price or not on those terms. It's quite rare. I mean, there are some kind of clear no-goes from an ESG perspective, but it's quite rare that it's that deals get declined kind of flat out right. More often than not, we find the return that we would like to earn or our clients to earn for the risks that we see is not what the corporate would like to issue debt at. That's kind of where the disconnect happens. And so the universe is very wide, but we do have a very big tilt towards infrastructure. That is also part of the national conversation at the moment. Yes. The need for economic growth is resting very much on the need for infrastructure investment. You'll see from all sorts of reports that Nedbank put out and all the other banks put out, our investment capacity and our infrastructure capacity has fallen off a cliff. And I think it's important that we unpack the reasons why that is the case. And I would argue that it's not because there's a lack of capital. There's very much a huge pool. There are huge pools of capital that are ready and stand waiting and available to invest. What's missing are the bankable deals. What's missing is the policy clarity, the policy coherence, the policy action, and some of the reforms, which while are happening, arguably, is it enough? Is it fast enough? Are there other things that need to be done? The investments are very definitely there. If I can maybe use an example, just to illustrate exactly what that is. If we look at the motor vehicle industry, and Valdine will know this, they are one of the bigger issuers on the bond part of the JSE. And they are multinationals as well. And there is a drive in South Africa towards electric vehicles, and the industry has put forward a set of proposals around how they see that part of the electric vehicle market working and developing, and the things that they need in order to make the investment that is needed here. And on the policy side, what's happened is, I think it was in 2020, there was a policy paper that was put out around green vehicles, and a policy around that, and that's kind of just got stuck. And that was in 2020, and now we're in 2023. And so if we're thinking about what do we need for investment, okay, well, maybe Toyota wants to open up an EV vehicle. It has access to capital because it issues huge amounts of bonds on the exchange. So it's not for lack of capital that it's not making the factory extensions or new factory investments that it needs. It's really around they don't know under what circumstances they will be able to produce and sell those vehicles. And this is in a sector, if you look at the motor vehicle sector, it's one of our biggest exporters, and it's a very big employer. And so as a priority, that is just one example of something that is holding up. So the money's, we would be happy to, we would be happy to invest in an electric vehicle plant. It needs to, there are other players that need to play their role in order for that to happen.
I can see Valdine is itching to say something on this. What are your thoughts?
Yeah, so there's quite a number of points from what Olga's mentioned that I'd like to run through, and that also resonates a lot with me. So, and also to some of your earlier questions, South Africa holds a lot of opportunity, but there's a lot of factors that we need to get right. Reforms, policy enablers, absolutely, and could we move faster? I think we could, but also starting off a low base, you could be braver. South Africa does not have good growth relative to any other country at the moment, actually. Whether it's EM countries or just developed world countries right now, we're quite low on a growth agenda. And actually, that's what comes down to the delivery. I fully agree with Olga. Access to capital, there's enough capital globally and locally. And aligning those access to capital or the availability of capital to accountable national agenda objectives is really the critical marry here. And when I say accountable, there's large elements of governance that we have to sort out. There's a large element of transparency. There's a large element of execution that we actually have to deliver on as a country. I say country because we collectively in this together. It's not government and the rest of us, And then I like to look at things positively. So the opportunity part is there. I mean, South Africa's trading at massive discounts in some of its public market stances. And there's a whole pipeline of infrastructure needs that are there that will actually unlock economic drivers and growth for the country. What it does mean is it means that the conversations between public and private sector really need to become more accountable and more aligned. That is something that we're doing quite strongly as the JSEs. Is not only are we the meeting place, but we're trying to do a lot of advocacy to bring these conversations closer together, because a large part of it doesn't have to sit in public markets, but they're the same universe, same issuers, same investor base, and then a lot of importance with public sector. So what we've been doing is we've been sitting with a lot of the corporate sector in South Africa, the companies on exchange, to understand what are your bottlenecks, what are your needs, and we're bringing those conversations in with government, with different ministers, with the presidency, with Minister of Energy, so some of the SOEs, there's Transnet, there's Eskom, there's we had a whole infrastructure pillar identified from 2020 to now. Have we moved fast enough? Probably not fast enough, because we're in such a critical state to unlock this growth. So we can definitely move faster. But in times of crisis, you have seen some fast liberalization. You look at some of the developments in the telco space with the elements of 5G and spectrum. You look at some of the energy reforms. Yes, we've been in a load shedding crisis, but you've also seen a lot of private sector deploy capital, hard-earned cash into projects. There's been over 100 billion worth of private energy and renewable infrastructure. Yes, people have done it to sustain their businesses and to sustain their operations. But come a year or come 18 months from now, we'll have a potential unlock of energy that we could try and use in a constructive way to sustain the country. So I really think there is access to capital. It's about finding these bankable projects. So how is this money going to be deployed? How's the money going to be governed? How's the money going to be transparent, accountable, and executed on, in 3 or 5 years, or in 7 years, or in 10 years? Olga's going to have to stand in front of her clients and say, well, actually, we put your money to this infrastructure project. The project is delivered, and the project is generating some type of cash flow that you can actually now retire on, or whatever it is. The same with foreign investors. I think there's access to capital, but when they look at projects that are being delivered globally, we have to look at South Africa. What are their attraction factors? Is there more stability in their currency? Is there more execution accountability? Are they delivering projects faster and with the standards that are needed? So I think the points that Olga raised, absolutely spot on. I think the need is now for those conversations to come together so capital can be deployed. Capital can be accessed, the capital can be deployed. But I also see that there's a lot of opportunity if we get this right. However, the time is absolutely now. There isn't a 3-year period of kicking around reforms or policy papers or beautiful documents. It's about actually finding the most pragmatic and tangible way to get the money and to deploy it in a responsible and accountable way for development for South Africa. And that leaves me optimistic because, you know, it means that you can be braver to try things and to grow the country. But it just absolutely means the conversations between public and private sector need to align, and we need to, you know, really get this driven out as a country level.
No, it's so key. Mama Kate, I'd like to bring you in there in where you sit as a strategist. And, you know, what we've touched on here is, you know, like, it's a conversation I'm always having with my colleague Adelaide about the rand, for example, where she believes it's now gone too far and it just doesn't make sense for it to be trading as high as it is. And I, as the eternal bear, having watched the rand for however long I have, I always believe it can go weaker, lower. It's never going to turn. It's done. So I want to know, from where you're sitting, what is it that we can do to increase the appeal of, you know, local markets? Because they should be appealing based on valuations alone, based on where they're trading alone. There should be people running to our doors trying to buy everything in South Africa, but they're not. What can we do to increase that appeal of our assets?
Okay, so I think there's a short term. I'll answer this question in a short term and a long term kind of framework. So starting with the long term, ultimately, you know, a currency is reflective of a country's competitiveness. The more competitive you are, the stronger your currency will be in real terms. And then that's really the long and the short of it. And that's relative competitiveness. So if you're getting less competitive relative to your peers, whether because as South Africa, I think we have over the past decade seen massive erosion of infrastructure capacity. Our infrastructure has been, the infrastructure that we had arguably has been destroyed. If you look at, for instance, the Transnet, our ability to roll out infrastructure to meet our needs has been insufficient for various reasons. For example, if you look at an ESCOM, and therefore our competitiveness has eroded. We've become more expensive, less efficient. I think we have the most inefficient, most expensive ports, for instance, in the world at the moment. So all of those things culminate in, you know, in us becoming less competitive. Our labor has become, because of our educational outcomes, which are subpar to say the least, our labor is less productive. So you add all of these things, and there is a real argument for why the rand should weaken on a real basis over time. The only way you kind of like stop that is to address all of those things that we've laid out. And I think we talk a lot about ESCOM, we talk about ending load shedding, we talk about Transnet, we talk about water, we talk about municipalities failing, we talk about outcomes for children at school, we talk about you know, subpar healthcare, potholes on our roads, all of those things kind of take away from it. So how do you get this right? It's actually dealing with those issues one at a time. I think there's been a lot of discussion around policy, blah, blah, blah. We all know we've been having that discussion for a long time. So I think, yeah, essentially that's what you need. You need to get on top of all those issues over the long term for the rand to be more competitive on a real basis. Over the short to medium term, though, there's always the commodity cycle that can always come and help us out. We saw that in 2020, 2021. It was very much around what was happening with the commodity prices, driven by excess liquidity, et cetera, but now that whole thing is in reverse, and here we are. Right? So, you know, that's the one thing that can help on a terms of trade basis, and that is very cyclical. It's that global cycle. You know, we spoke a little bit about China and how weak that economy is at the moment. We need to get the next sort of like demander of commodities to fall into the breach that is being left by the absence of China as the, you know, consumer, uber consumer of commodities going forward. So where's that infrastructure globally going to come from? because if we cannot be competitive out of our own, what we generate, we need to be competitive because there is a demand for the things we export, and at the top of the list, that can be a high beta kind of play is commodities. So I agree with you that in the medium term, I need to find a positive story for base metals, and I don't know where you find it right now. I think it's a hard ask. Then you've got like now the sort of like even shorter term story, which is around what happens in the next year or so, right? And I think that is going to be very much about what happens in markets other than ourselves. So what happens with the U.S.? In Bloomberg, you guys work at Bloomberg, day in and day out, U.S. inflation, U.S. Fed rates, 10-year. So yeah, I think that becomes like, from an intraday perspective, I walk into the office and everyone's like, "Oh, where's the U.S. 10-year? It's a 4.20. Oh my God, where's the SAR?" So like that's kind of like in the mix. But I think there's a really strong story for a stronger rand in the next year or so, and it really is around I think Valdine spoke a little bit about electricity investment. So part of the reason assets have been so cheap, and with good reason, is because we've had no power for the better part of 10 years, right? And if you can resolve that issue, even incrementally, even if you're not saying you have zero load shedding, but if next year is better than this year, growth should be better. We should be more competitiveness. The cost structure for the economy should be a bit better. And I think on balance, that means it's a good story for SA Inc. So I think the story for ZAR really for the next 10 year is quite strong. It's quite constructive. But in the meantime, if the US falls into recession, I mean, you can go to 20, you can go to 21, who knows? This is after all. But, like you said, that thing is just like, it keeps us all very busy. But I think that on balance for SA equities, I'm quite constructive. If you can look through the noise, I'm quite constructive for Rand if you can look through the noise, but it will be very noisy in the short term.
This is a term I think keeps appearing in the panels that we've had, including earlier this week, where some of the noise that may be appearing soon will be political as well, with the upcoming elections. So I'll be very curious to see how it all plays out. I hope the positive people in this panel do the right thing and allow the rand to do an even better thing, stocks to do an even greater thing, and infrastructure to boom. But I'll take a pause over there to ask the floor if they have any questions for our lovely panelists. We'll start with Timothy in the back.
Okay, hi, thank you for the insights. So there was mention of the enhancing of transparency in the capital markets, which of course is important for the efficiency of those markets. So just yesterday, we had the New Development Bank issue about 2.67 billion rand of new bonds. So with regard to that, so as the head of credit, or people that are deeply involved, not just the head of credit, but like all of you are very involved in the capital markets. So how do you believe, what factors do you believe like investors should consider when evaluating the credit worthiness of the NDB's newly issued debt and upcoming debt? I can imagine that they still want to, issue more in future, especially in comparison to South African government bonds. And then also, how do you interpret the strong demand that just came up out of nowhere? That was quite a surprise. And then, what market trends or factors could be driving that? And lastly, could you just provide insights from the Johannesburg Stock Exchange perspective, or Securities Exchange rather, on in supporting the NDB's future bond auctions further? Thank you.
We'll just wait for our panelists to answer that question before we go to the next one. Thanks.
Okay. Sure, how long do you have? I mean, the credit assessment of any entity talks to the factors that I mentioned earlier, the non-financial factors and the financial factors. And so one would look at the creditworthiness of an entity and the view on I think they issued 1 and 3 year bonds, on that view, and whether the price that they're offering to pay you is commensurate with the level of risk that you as an individual investor sees. And what we see at Futuregrowth might be different. The risks that we see and how we price for them is often different to how other market participants price for those risks. I think we're at an interesting place in the market at the moment, certainly on the debt capital markets, and I'm interested in Valdine's view on this. But I think there is an excess of demand relative to the supply of bonds that are available, and that potentially is skewing some of the price fundamentals. So I think many issuers are able to get away at much lower credit spreads than the credit environment would warrant, than potentially their individual names would warrant. And that's really because everybody has assets that they need to deploy, or investments that they need to deploy, and there's very big competition, and the auction methodology is the way the price discovery happens. And so you if you really want to get in on an asset, you bid quite competitively. And the excess demand has the effect of pushing down the credit spreads. And in some instances, it has dislocated a little bit from credit fundamentals. Yeah, whether that is going to continue, I think, is potentially a function of how many other debt issuers come to market. The universe of credit-worthy entities and where capital can go is quite limited, and a lot of that has to do with the lack of other investment classes around. There's no infrastructure spend, for example. The SOEs municipalities are in a troubled state. They have not been able to have primary issuance on our capital markets for a very long time. So that capital that is waiting has to find a way into other assets. I think this demand-supply dynamic is potentially feeding a lot of the compression in credit spreads, which are potentially not reflective of the credit environment, the fundamentals in the credit environment.
Can I just say, I think what we've seen in South Africa from the mid-10s has been, because equities have underperformed so much, there's been a reallocation of cash into other types of investments. And what one would have expected to see is some of that cash going into bonds. I was having a debate with somebody actually yesterday. They were asking, why is it that government bonds are where they are, given how much cash there is in the system? And what people then did is they took the cash that they would have directed towards equities, which has historically been where a lot of the allocation has gone in South Africa, and they put it in income assets. So that would be your income funds, your cash plus, so very short duration types of investment places. What then happens is that cash then gets trapped there. We saw that that almost balloon, out of sight, I think, during the COVID crisis. The deposit levels went sky high. And now you're sitting with a lot of cash, and then it's like, what do you do with that cash? And it can't be deployed in long duration assets, but because it's waiting for an opportunity, and that cash then gets deployed into credit type instruments. So if you are an issuer and you come to the market with anything that is like 1, 2, 3 years, that is floating rates or that is floating rates, the demand for your asset is going to be really, really high. And that's what we've seen. The flip side of that is that we're an economy that is ex-growth and has been ex-growth for a decade. And because we're ex-growth, there aren't a lot of investment opportunities. So you can't go into equities. There aren't a lot of companies that are investing, that are issuing paper. And so all this liquidity is trapped. So I think that trapped liquidity issue is something that we need to keep at the back of our minds as South Africans, as we think about what is it that we can do, because it does mean there's a lot of options on the table in terms of what we can do if we get our ducks in a row. But it also means that for certain assets, you find that assets are very, very expensive. When I saw Olga today, I wanted to ask her, so what's your pipeline like? Because I knew she would be struggling, right? And that goes for every single shop. If you speak to any asset manager out there, there aren't any assets. And there aren't any assets because there is no growth. There's no growth, and therefore there's no return. So you've got like a lot of cash that is chasing whatever asset you get out there. And I think it's a very important point to make about South Africa's capital markets and the capital market development and the depth of our savings industry, and the fact that we're an outlier within emerging markets, and we're the only country that is caught in this kind of like vortex, so to speak. And you know, like when people talk about, you know, the fact that South Africa is probably the biggest, the only emerging market that is as big an investor in global markets as we are. So South Africa invests a lot outside of South Africa, and that is deeply unusual as well. And I think it speaks to this idea that when it comes to cash, South Africa's got cash. We've got cash, we've got the savings, we've got the infrastructure around it, we've got the institutions to get the savings in. Well, what we're struggling with consistently is creating the opportunities for that capital.
Yeah, if I bring it back to some of your original questions, yes, New Development Bank did an issuance. They've actually done a few issuances in the regions that they cover, largely the BRICS. So this is the first in South Africa, but they've done other issuances in some of the other emerging markets. To Olga's point about demand, absolutely. We're seeing in general high demand in the bond space. It's a function of many factors. The JSE repositioned our green bond framework to a sustainability segment, and we expanded our bond issuance in 2020, the framework. So we included green bonds, social bonds, sustainability-linked bonds, and within that we saw various permutations. First, Sharia compliance, Cook in the agriculture space. We saw one of our corporates issued first gender-linked bond, etc. So there's definitely this focus towards more development, more ESG, more sustainability factors. But even within that sustainability segment, where globally people even compromise some of the return they're getting because of the long-term forward factors that they are looking at, we saw high demand. Most of those bonds were 4 or 5 times oversubscribed, and in general that's the case. So you're definitely seeing high demand. We also saw, you know, South Africa went to sub-investment grade over a 2019, 2020, 2021 period in various tranches. And even when we fell out of global indices, there was the knee-jerk of a sell down in bonds, but then you just saw absolute buying, even if it was not for tracking. That was because of a return basis. South Africa stood quite good on a yield perspective. That's different now in a high interest rate, high inflation environment globally. But in general, South Africa, you know, to Olga's point, on a risk-adjusted perspective, people were reviewing your risk versus your return and making a decision. So we're seeing good demand in the debt space, even though there's a current period now where we're seeing net selling of some of our local bonds, but you are in general seeing some of the issuance have good take-up, like we saw with the NDB issuance. I just have to say, you know, there's lots of opportunities. We are seeing some of our local market putting their money to alternative assets. There's been increase in alternative investments, not yet fully allocated, but people are starting to look at alternative investment classes. We did see a sell down in some of our local equities and bonds into offshore allocations from some of the regulatory changes. But I do think globally people are externalizing money. I don't think everyone's putting money into their own local markets. It's very select in certain markets and on growth. I mean, there's pockets of developments of buoyancy. You look at Saudi Arabia, that's having a buoyant capital raise market in its public market. Or you look at South Korea, that's moving potentially from emerging market to developed. So there's pockets of different markets. If you look at the interest rates that have risen so quickly in European markets or in the US markets, in some of the developed markets, I mean, they've gone from 0% on some of their interest rates to now 4.5%. I mean, those are huge moves, both on the lending side as well as on the borrowing side. So it's, you know, it's quite fast-moving markets with constraints. But the bottom and overarching premise across every global market now is liquidity, and the liquidity is really important because people want access to their money quickly, and then they want some type of return that's a bit more stable. So I think we'll see that transpire in different shapes and forms over the next 6 months, especially as monetary policy stances change globally. Yeah, much shorter. Yeah, it certainly will, and also to how they're going to be deployed. You know, you can't compare that to a long-dated government bond, for instance. But yes, it'll speak to the nature of how they're going to be deploying that cash.
Right. Thank you, ladies, and good morning. I'm getting a bit of a mixed feeling sense here. You know, there's that happiness that there's money, and then there's that part where we depend a lot on the government to do a lot of stuff. So I think perhaps my first thing will be, how about we change the branding? You know, the rand is weakening, even if and what's causing that? A whole lot of sentiment, right? What if we become like Americans? Believe that we are ignore everything that's happening right now. And then create movies where we have these Russian mafias coming, and then the SAPS overcomes them. And then we have the Chinese coming to do this, and then the government brings in more money and then wins the case. You know, just change the narrative. And we ourselves maybe might start believing in ourselves a little bit more. So here's my question. In terms of asset management, how big is the disconnect, or perhaps the connect? And I'm glad that you spoke a little bit about alternative investments. In that, what is the appetite with pension funds in investing in alternative investments, particularly private equity? Is there an appetite there? Is the risk too high? Is the term too long? What's happening in that space?
Look, the pension market is huge, right? And different people have different risk tolerances and different risk mandates. And so the universe of mandates is from very low risk, people who want to invest in the money market, they maybe about to retire, they want they want to preserve capital, all the way to very young people who are prepared to take on a bit of risk in order to see their capital grow. So the mandates are very wide and very deep. The appetite is very much there. I mean, you've seen the growth in alternative asset classes. It's no longer just the question of listed bonds and listed equities. There's, almost every single, I think, asset manager has an alternative investment offering. And so the mandates are very definitely there, and the money is there. I think it's interesting what you say about, to change the narrative, and I agree with you. I think we do need to change the narrative, but it needs to be based on issues of substance. I think we need to be realistic and very clear-eyed about what needs to happen, and the conversations that Valdine mentioned have been happening for quite some time now. I think we need to move past conversations and we need to move into action. We are seeing some of it, but we need to see more of it, and it creates its own kind of flywheel. Alternative investments and particularly infrastructure investments, they have long lead times. And one of the comments that's been made, I think it was made by the Minister of Public Works just the other day, that projects, if you want to build a new water plant, you can't just decide tomorrow, okay, let's put it up. You need to get land use permits. You need to, figure out demand. The tariff needs to be sorted out. You need to figure out, which municipality is going to, or which water off-taker, the legal agreement. There's a whole range of work, and then never mind all the actual putting the things in the ground. That also takes time. And so these long lead times mean that decisions need to be made much more nimbly and much more kind of in a focused way and in a prioritizing kind of way. So electricity, absolutely, there is a whole lot of new generation capacity, private generation capacity coming in that needs to be augmented by public grid, but there's a grid problem. And so investments in the grid are needed. Those take 7 to 10 years to kind of come to fruition. So we can't wake up in 5 years' time and say, oh, okay, now we're going to start on looking at augmenting the grid. We actually need to start today so that we can be ready when all these new power projects, because they take 2 or 3 years to build and to be operational, so that when they are operational, they actually have something to plug into. So if your question is around, are the mandates there? Do people have the risk tolerance for alternative assets? I think the answer very definitely is yes. The question that we have, or the need, is in the actual assets to invest in. That's the missing piece at the moment, the bankable assets.
Yeah, but maybe if I can just add, I think the power of positive narratives, absolutely right, to Olga's point. You can't do it with rose-tinted glasses. You actually have to have, okay, what are the actual items that you are showcasing? There's some that, South Africa has is quite rare in many counterparts that it's compared to, is that we have mineral assets in the ground, which has been the commodity cycle that's been our underpin for capital markets and our growth and development. But we have also, other growth. South Africa's quite developed in many facets compared to some of its other emerging market peers. So we have to figure out what's the right balance that we're showcasing. We have to execute faster. So I definitely think positive narrative and honing in on what are we delivering. And that's why I think these public-private sector conversations are important to be aligned and accountable. I keep saying accountable because we have to say, we're going out to say, this is the opportunity to invest in. Now we better deliver on it and show what it will unlock. And that happens together because a lot of the money sits with private sector. A lot of the delivery has to come from the country level delivery. To your point about private equity, I think that also comes out. Infrastructure is a big pillar for South Africa, but so are SMEs, so are startups, so are fintechs, etc. That we have to hone and grow, not just for South Africa, but for the continent. You often see headlines for the JSE of the JSE's universe of listed stocks are shrinking. But a lot of the companies that we see delist are in the small and mid-cap phase. They haven't found a healthy growth environment on the public markets. But it doesn't mean that they don't exist. They still need money to grow. They still need an environment which will help them grow. It's not fully private equity, but some of them go private. And they'll still need the company. That's what our pillars for employment in South Africa, for growth, for a second and third order of economic development for South Africa. That cannot be forgotten about. And like the JSE launched JSE private placements, we realize that there's a place for public market and then there's a place for growth. We've had 32 issuances in that private placements platform of asking for about almost 6 billion rand in capital. So it shows that there's a place and home for different segments, but they're absolutely areas of focus for us at a country level. I don't think one tops the other because all of them are parts of the economy that will help the whole picture flourish.
So let me just ask my question. My name is Adede. So I was going to ask you about the private markets that the JSE launched and the performance. Was that what you expected? Was that, you said what 30 companies, give or take, 32, raising 6 billion?
Yeah.
Was that where you thought it would be sitting at this point in time? And then just beyond that, also just on private equity in total, apparently the amount of money sitting in private markets is about 200 billion. The pension sector is about 3 trillion. So, where is the disconnect? Why is that happening? And then can I also ask, please, about the Regulation 28? You've mentioned that, about the dislocation and some of the challenges that it brought about. Are we anticipating more? Some companies have already gone up to their allocation to 45%. Some are still sitting quite low. What is the impact? And then beyond that, the two-pot system. Sorry, I'm just
Let me intervene there. Can I just ask the panelists to keep the answers a little bit brief, short? We're running out of time to the end of our panel, and ask that Adelaide ask the remaining of the questions privately on the side. Let me go to refreshments, and that's all right.
You guys will catch you, but on the two-pot system as well, that's coming through at some point next year. Pension funds have to kind of liquidate a third of their assets because people will be able to access a part of their savings. What is the ramification of that, and how are you dealing? And then my last question is on, the green market and the lack of a premium for green products, and what is required for that to happen, because if there's no, in the greenium exists in many of the other markets, makes the green assets attractive, makes, incentivizes issuers, makes people who are buying them happy. So what is required for us to get there, and to also kind of unlock the potential that exists in the carbon markets? Thank you.
So very quickly, private markets, what we saw is there was a massive shift globally between public and private assets. And there's a growth in private markets, and we responded accordingly and launched JSE private placement. It's only been in operation now for just over 18 months, from March last year to now. It far surpassed our expectations of success, in that we've seen so many issuances come onto. It's a place and a home as an incubator for growth companies. We also saw over 12 billion worth of investor assets on the platform. What is taking longer is the matching of those two. So the deals are there and the assets are there. And like I said, far surpassed our expectations, but there's a longer due diligence period in getting to know these companies compared to public markets. So it's a longer lead time to convert, but it's absolutely been a good case study for success, and it's needed for South Africa. It's an alternative form of capital raise. With regards to the pension, to the Reg 28 changes, yeah, it's been, I would say, dislocating in a sense. You've seen many people sell down local equities and bonds into offshore products. So there's always been a demand for offshore investment. People want to diversify, but you've seen people move to their 40 and 45%. What has been, I think, a little bit disappointing, or a consequence of that, is not only has the investment gone to offshore, but the capital management of that. Many of them have lost the local management to offshore management, and that has a skills and a development implication. So whether we see more of that, I think there'll always be a demand for people to have options to invest offshore. How it's done, I think we can be a bit more, creative or considerate in having more onshore capital product options for offshore exposure. And we need to figure that out, how you have product onshore. And your third question was around sustainability and what type of yields or what type of returns they generate in general, or the green economy. There's many pillars to the green economy. There's debt issuances, there's equity issuances, or companies that are green or less green. There's commitments that are being made to COP by 2030 and 2050. 2050 for net zero, but many people have 2030 commitments. And then there's economic drivers. Is there a green economy South Africa unlocks? There's talks of what a hydrogen economy looks like. There's talk about what carbon markets and the BCMs look like for Africa as a whole. Lots of opportunity. Unlocking the economic feasibility, funding those products, getting them to generate the right returns. That's a journey. Lots of advocacy, because South Africa is a carbon-based economy. Most of the continent's a carbon-based economy. To generate the right returns on high-quality carbon credits, or on hydrogen assets, or on sustainability bonds, or whatever the instruments look like, or mechanisms for exhibiting a green investment, is what we have to unlock, not just as a country, but as a continent.
I mean, maybe just to add one point on the green economy, and companies that want to issue, I'm talking from a debt perspective, debt at a lower cost of capital because of green metrics. Our view on that is that those green metrics need to go above and beyond business as usual. So if a company wants to benefit from cheaper cost of funding, there needs to be measurable targets that they are accountable for, that go beyond just kind of the normal course of business. That is what I think would be rewarded from a capital perspective, because then you're seeing a step change in the kind of green response. What isn't that helpful to us, and we have seen, some of it is, a green bond being raised for kind of quite amorphous purposes, and for quite kind of low grade targets. You don't want to set a target of something that's kind of quite easily achievable. It should be, in our view, in order to benefit from a low cost of capital, it should be a stretch target, because that speaks to the ongoing sustainability of an entity in the longer term, for which they should be rewarded with a slightly lower cost of capital. And I think that might be some of the missing pieces as we see it in the kind of green space, certainly on the bond side. I just wanted to add that in.
Yeah, and I think I just want to speak to the two-part system, and it's something that we need to think really, really carefully about. And I think to the extent as a broadly speaking as a market, we're probably going to be more reactive than proactive around that issue, because it's not clear at the moment what the outflows are going to be. So you can anticipate that there will be some, but it's not clear that it would be exactly the 1/3, for instance, that is being proposed. So you need to worry a little bit about what that might mean from a liquidations perspective. But like I said, if you look at the way pension funds have allocated, I think they've got quite a lot of short duration assets relative to where they have been historically. So to some extent, there might be a willingness to run with a bit more cash, and maybe there'll be a little bit of a liquidation, but it's not clear to me that it would be the full third, for instance, of what people are allowed to liquidate. Then on Reg 28, the Reg 28 story was really quite interesting, that increase at the time of the budget from 35 to 45, especially given what was happening with respect to government debt, the need for government to issue more debt, and the need for government for more capital. So it was really interesting timing around that. But anyway, it happened. And, you know, as a consequence, yes, we did see quite a lot of people, you know, externalizing their funding. But I think it's important to think about where the rand is when you think about how money is flowing in and out of the country. So there is a bit of a structural reallocation, I think, that was happening where, and that would be at an advisor level, not even at a fund manager level, where advisors were saying they'd never even gotten to 35%. South African assets haven't done very well over the past 10 years. And maybe if you look at it over a long-term basis, you should have been better allocated, and people have taken advantage of that. But I think there is also the fact that the rand is at 18, 50, 19. It becomes a lot less compelling, right, to take money out. And also what tends to happen is that when the rand depreciates as much as it has, you know, people's assets get revalued because they're sitting in dollars, they get revalued in rand. Before you know it, you haven't moved money out, but you're already at your target. So I think the weaker the rand is, the less pressure you'll see for money to flow out. And we have seen actually a lot of guys starting to talk about getting to their limit, having to bring cash back, etc. And in fact, the fact that you have as much holdings of foreign assets by South African pension funds tend to itself place a speed limit on the rand. So when the rand blows out, eventually everyone's at their target and they need to do the reverse trade. And we definitely did see quite a bit of that at above 19, for instance. So I think, you know, that it is a two-way street, and the sort of like the exit part of that story is probably done. Now you're kind of like there where you're balancing things back and forth.
Thank you so much, guys, for the questions. I'm sorry, you're going to have to keep your question for refreshments. This has been a stunning panel. I've really enjoyed chatting to you guys. Thank you for giving us your time. I think they're going to have one more word from Amo.
Yes, thank you so much for this riveting discussion. We unpacked quite a lot, and thanks again to our moderator. I think it's really crucial to be having these kind of discussions, particularly in the Joburg office, as we prepare to launch our new TV studio later on this year. And I'm hoping that we'll be having our panelists on a regular basis to kind of give us some insight on some of the market developments. Thank you, everyone. You're welcome to have some more refreshments before your departure.
Oh my God. More.
Risk. You think it's kind of the worst is done?
No, I think it's like, it's one of those things that bubbles under the surface. So my biggest concern, and that's the one thing I'm not on top of, is that on balance, pension funds are not a